Hello and welcome back to the Note. We've had a relatively calm, quiet day today. Some somewhat anemic data on the US economy with GDP growth not very impressive in the third quarter. Many people waiting to hear from the Bank of Japan later on this evening. But the overall picture remains fairly straightforward. Stocks have largely held on to their gains of the last few weeks. We've had a rebound of more than 10% in the US stock market over the last month. And the interaction between the stock market and expectations for rates remains really very perplexing. What we're showing you here in the red line is the chance of rates not rising after December as derived by Bloomberg from the Fed funds futures market. It has today come back down to exactly 50%. The market now sees this as a pure 50-50 shot whether the Fed raises rates in December. As you can see, that expectation has changed a lot over the last 3 months. Meanwhile, in the case of the stock market, you see the very dramatic tanking early on in August, largely driven by the catalyst of China. And then, rather intriguingly, you see stocks falling once more when the Fed passes on raising rates in September, but then starting a very strong recovery, perhaps more in line with what you would expect once poor unemployment data at the beginning of this month suggested that the Fed would stay on hold for even longer. What's intriguing is that despite the clearly more hawkish message from the Fed that we've received this week, the Fed doesn't feel comfortable evidently with the message it sent out last time around and wants to convince everybody that it wants to raise rates in December. Despite that, the stock market has largely held on to its gains. The single clearest reason for this would be that the earnings season for the third quarter is at this point quietly turning out to be a fairly positive surprise. More than 70% of companies at this point have beaten their expectations for earnings as far as Thomson Reuters is concerned. At this point, the outright fall in earnings compared to the third quarter of last year is below 2%. There is a faint chance that we might actually still see earnings rise very slightly year on year. So my best guess for the time being, given this very strange dynamic we have between expectations for the Fed and the stock market, both of which have gyrated very dramatically over the last 3 months, my best guess is that earnings are, for the time being, pulling the stock market through.